Sanjeev, welcome to the podcast. It's a pleasure to have you being the interviewee this time. So welcome. We've
Thanks,
had
Tonya.
we've had a very busy week at S2G and a lot of great milestones. So we have so much to discuss today, from your new financing reality report to this year's summit and a pretty significant fundraise. So we'd love to kick things off by starting a little bit about the report you just published, Financing Reality. You open that report with a claim that the real economy moves faster than the financial architecture built to serve it. Over 300 years, those who have done the best have been the market builders rather than those who recognize the trend. Can you just start by explaining what you mean by that?
Yeah, so I think what I mean by that is often when you see regime shifts, macroeconomic, industry, secular, capital markets, an observed reality changes and becomes an emerging reality. And whether it takes 1 year or 10 years or longer, that emerging reality often stays subscale or emerging and never really emerged because sometimes the capital markets don't have the vehicles to finance it going from 1% of something or 5% of something to 10, 20, 30, 40% of something. And the market builders, to me, observe an emerging economic reality that is proven, has 1% share, 5% share, whatever, and then build the financing mechanisms to make it going from emerging to emerged. And that's where I think those market builders is where outperformance exists because it's the right risk reward. It's not unproven, it's proven, but it's just subscale. And it's subscale because the current financial and capital market architecture has not been built to finance it from from emerging to emerged. And I think that's the most interesting risk reward that exists within capitalism.
Yeah.
Because it changes beta, creates outperformance, i.e. alpha, and it's done in a way that's not completely moonshotty as well. And I think in 300 years of economic history, financing that emerging reality, that emerging observed reality, we see a consistent pattern that I'm sure we'll get into.
In the report, you talk a lot about the late 1960s and 70s as a
Yeah.
defining inflection. So maybe talk a little bit about those. There were a few forces that converged at that time and how that set a playbook that is now changing.
Yeah. And I think, to me, these regime shifts happen every 30 to 50 years and they change beta and they create, for the market builders, they create alpha. And in the 1970s, I think, we talk about four transitions that occur. Nixon getting off the gold standard that led to sort of fiat currency scaling, and we've gone from 3 trillion to 300 trillion of debt, to the Nixon to China moment that really was the birth of modern globalization, with China eventually entering the WTO and supply chains fundamentally changing around the world. And you have modern sort of just-in-time globalization where a lot of the fixed assets are in China and they're the factory of the world. Three, and this was really scaled in the early 70s or late 60s, was Moore's Law, which created, the scaling of compute. And then four, again, you had the boomers and just a demographic dividend. All four of those things led to, I think, Moore's Law really led to the birth of Silicon Valley and compute and sort of institutionalization of venture from an artisanal asset class to institutional scale. I think the notion of globalization led to trade finance, which is now, a legitimate part of the capital market system. The savers in the boomers that still are the modern savers of our economy and society. I think that led to a lot of things around those four transitions. I think led to consumer fueled consumption. It led to a period of enormous GDP growth, stable inflation, sort of correlations kind of holding together for until recently, the last 5 to 7 years. And that led to sort of modern portfolio theory scaling, and the modern
Mm-hmm.
portfolio led to ETFs, and that's now a $13 trillion sector. And so that's sort of the repeat of history is those that saw this emerging economic reality and observed it and saw it was proven, but were subscale, made a lot of, I think, returns and outperformed the market.
Yeah. We've been talking a lot on this podcast about the age of adaptation and the five forces that are driving that: intelligence, power, money, entropy, and a changing, demographic through aging. Can you walk me through those briefly and talk a little bit about how that's changing the market and maybe what the market's underestimating right now?
Yeah, so I think we're at a early 1970s moment today. I think these five forces, really COVID spurred it, but these five transitions are akin to the four that I mentioned. So CPU to GPU, shorthand AI, unipolarity, multipolarity, i.e. shorthand geopolitics and power, um, declining price of money because of what happened with getting off the gold standard to an unknown price of money. And just even the bond market action yesterday kind of proves this. 1.5 to 2.5 around climate and heating. And then a demographic dividend to now a demographic headwind, i.e. aging. Each of these five are secular generational type events that I think
Mm-hmm.
could impact supply chains and who wins, who loses in market share, and et cetera, et cetera. I think the cocktail of these five are, I think, profound and will change reality. And who finances that changed reality, I think, is a jump ball. And that's what I'm excited about, frankly,
Yeah.
is I think we'll observe that reality change sooner in our sectors because we're only focused on our sectors. I hope, and have scale and a lot of people and dry powder to invest, and a large ballast of portfolio companies already to sort of see in
Right.
an ecosystem network that hopefully gives us a sneak peek, if you will, into terms of changing emerging reality, and then hopefully we can design the financing vehicles and partner with companies and platforms to do that. I think these five, just in we've been sort of moving. I think we're going to move from an era of moderation to an era of volatility. We've been working on that since COVID, really, but we really articulated that publicly in 22, 23, and it's accelerating at a pace that I didn't think that you know that I didn't think a year ago that it would accelerate at. So clearly, intelligence, i.e., AI, you've seen significant growth in inference.
Mm-hmm.
You've seen model behavior go 4 or 5x, and model performance, and you're seeing significant demand for data centers and compute now. So clearly, AI intelligence is getting, it's kind of all everyone wants to talk about in some ways, but it's clearly getting more momentum. Multipolarity, you know, um, G7 versus BRICS economic growth is changing. We've had the most conflicts globally since 1946. So the global order is getting more multipolar,
Mm-hmm.
and what's happening in the Straits of Hormuz and what's happening in China, with Taiwan in the last week's summit is another sort of forbearance of what is occurring. On unknown declining price of money and unknown price of money in the last 12 months, that's also accelerating. I mean, you're seeing the Fed cut and the 10-year go up. That hasn't happened in 40 years.
Mm-hmm.
You're seeing the issues around the marginal buyer of the 10-year being questioned. I mean, for a long time, the 10-year was interest rate or currency sort of management. So Japan bought a lot of it, China bought a lot of it, the central bank bought a lot of it, but the incremental value of the 10 years unknown. And the 10-year then has all kinds of cascading impact on cost of capital, weighted average cost of capital for companies. And I don't think we fully imputed what
Mm-hmm.
higher cost of capital means in terms of who wins, who loses. And then 2.5 degrees heating, you're seeing, ocean heating at significant, used to the super El Nino, you're seeing significant damage in homeowner insurance markets, et cetera, et cetera. I think aging, you're going to have more deaths than births in the U.S. by 2030. That's a global. Everyone but South Asia, Indonesia, and Africa, I think, have significant demographic issues in their economy and their society. That has implications for consumption. That has implications for labor availability, et cetera, et cetera. So these things are accelerating, not declining. I think everyone's underwriting to one or two of these. I think we're trying to underwrite to a portfolio and a platform of all five of these happening at
Right.
once.
I mean, there's so much talk about AI and the markets watching the implications of that. But what of those five do you think is the most underestimated?
It's a really good question. I think AI is clearly the oxygen in the room. I think multipolarity and geopolitics, because of what's happening in the Straits of Hormuz and with U.S.-China relations, that's gotten a lot of buzz. So those two things I feel like are getting adequate attention. I think aging is not getting enough attention, and I want to pair aging with price of money. We have over 50 trillion, if not more, maybe even over 100 trillion of unfunded aging liabilities for pension and healthcare. And that is going to further have implications on the price of money. And so you have significant issues on our fiscal situation, on most governments' fiscal situation. And you do not have a thoughtful approach to how do we lower the cost of aging, whether it's healthcare and deflating healthcare. I think food systems play an enormously important role. And then on the second hand, what happens to labor productivity as people age, and what's the role of autonomy and robotics and automation and all that? And so I think that those two things are not getting enough attention, and particularly the role that the food system can play in that. I think on climate and sort of 2.5, I think we have to do both mitigation and adaptation. And I think when people talk about the age of adaptation, people automatically think it's climate only. It's actually all five of these things. I think that the thing that I want to point to is around 2.5 in geopolitics. I don't think that gets enough attention in terms of there's going to be winners and losers in a 2.5 game, and it's going to have geopolitical implications. Including, which wars get started because of access to water or access to, I think, migration issues. So I think all of these get some level of attention, but I think the interlinkages of these don't get enough attention. And I think that's something we're trying to highlight more and more.
Yeah. So it really highlights the importance of having a systems lens, right? Really understanding how these things intersect. In a recent article, you wrote that the can openers of the last era are not coming back. So you've hinted on this, but can you say more about why the last era's playbook and what that depended on? What's broken about applying it now?
I think, the my favorite chart is like you have EBIT margin on one axis and then revenue by invested capital on the other axis. And then you had, you have this classic curve of return on invested capital, and it's kind of, there's not many companies up and to the right, but the last 30 years has allowed that to occur. Meta, Google, Microsoft, a lot of software names, biotech, pharma. You've had high gross margins, high EBIT margins, and high, revenue and invested capital. So high ROICs. That era fueled institutional asset owners allocating to this across asset classes, venture, private equity, etc., public markets. And so you've had enormous asset light approaches that were high EBIT margin and high revenue divided by invested capital, return on invested capital sort of opportunities. Now you're seeing, I think, the physical economy and physical commodities intersect with this. So as you know, like my view of climate investing, it's the longest economic megatrend in human history. You take useful energy and turn to useful materials, you know, photosynthesis, fossil fuels, and whatever comes next. The useful materials were calories, electrons, energy density, and water. And now there's this notion is you take energy and you turn it into useful intelligence to drive ROIC up. In order to do that, though, you need a lot of physical commodities to fund that. So you're having sort of the Mag 7 have utility level CapEx, in terms of the need to deploy. And without a clear understanding of the revenue model, the clearest in the gross margins of AI market share, but it's causing significant sort of tumult already. You're seeing the SaaS apocalypse, and so the terminal value of software, is it worth 3 times revenue, 7 times revenue, 12 times revenue, 1 times revenue? We don't know. And that's going to stint a lot of capital flows to software just fundamentally because you don't know your exit multiple. I think, so that's sort of one aspect of this. But if you just step back and say, what are these 5 forces going to do? The way that, I've thought about it is the value of any business. That's just anecdotal evidence, but the structural thing is the value of any business, in my opinion, is its scarcity value and or its ability to generate cash flow. Ideally, both. So, is your company scarce, and can it generate cash flow? If you look at 150 years of, multiples, we go. It's no matter like if you have a great business, not so great business, multiples change based on these regimes. The 5 forces, I think, define this regime, but every 30, 50 years. And so if you look at the historic average of 150 years, it's 17 times earnings. We're at 40 times today. And it's gone as low as 5. It's gone high as 44, 45, I think. Maybe a little higher. And so we're at I don't think people are really understanding how these 5 forces affect multiples of earnings. And I know, history never repeats itself. The past is not the future, but you these things move, and regimes move them, and you have to look at the second or third order things that move these multiples. I think the second thing is the ability to generate cash flow. The durability of cash flows is something that's not taken for granted. I think you've had one company from 1929 that made it into the 21st century, and I think the Dow 30. And so, large firms fail,
right?
And they don't last. And the durability of cash flows and the multiples attached to earnings, I think, have enormous and profound implications. And I think we're sleepwalking into this without really understanding the drivers of how to do buy low, sell high, or buy high, sell higher, or buy high, sell low. Hopefully you're not doing the third thing and not doing the second thing too much.
Do you see any signs that the markets are starting to reflect this change? Like, are there any signals that you see highlighting physical scarcity?
Yeah, I mean, obviously you have data around software, and sort of the aversion to software, and then you've got the growth of the growth in power stocks and energy stocks in general. So that is very clearly, I think, been articulated the last 3 to 6 months. The second thing I don't think I'm excited about, but I don't think the market yet sees, is the role of diversifiers. Because it's a one hallucinogenic bet that AI will require $1 trillion, if not more, of infrastructure capital, compute capital, et cetera, and that will yield, tremendous sort of value, really in automating workflows and knowledge-based work, mainly services, which, that's the bet. That's sort of the red pill, blue pill you have to buy into or not. I think, if and it's 7 stocks to represent 35% of the S&P, it's one country largely, it's kind of one energy fuel, mainly natural gas. That's the bet on it. And it's 40 times earnings. So we're all in right now.
Yeah.
I think what is needed by people is diversifiers. And right now, if you are not in that red pill blue camp, and you're worried about equity markets and maybe like issues with the bond market, which happened yesterday again in the 30-year, going to the highest level since 2007, you don't really have a safe haven. And the safe haven has been gold, to a certain extent, silver, maybe Bitcoin. And I think there's a lot of real assets that are obsolescence proof in many ways because they produce inelastic things that humans need every day. And, we obviously have done a podcast on farmland, but there's all kinds of other real assets that I think offer an uncorrelated safe haven. If you're not yet a believer, or if you want to barbell your portfolio. And I think that is an emerging reality that I think I'm excited to build into beyond, what we've done in farmland with Clear Frontier.
Yeah.
Because I think there's a whole there's an assembly line of real assets that will be uncorrelated and survive, whether, the S&P goes to 8 or, goes up from 40 to 45.
Right. One of the things I hear you say a lot, and I know it's one of your favorite phrases, is the riches are in the niches. So is that what you mean by that? Or can you say more about what that means to you?
Yeah, that's exactly right. It's like, okay, there's an emerging reality. Consumer voting with the program on organic food, proven. At scale organic agriculture, emergingly proven that people do it. But the capital is a 1-year cash lease, not a longer term offtake. And you could actually double the cash yield if it's, organic, and then you need a capital vehicle to do that. And hence, financing the reality of this emerging reality. And so we can do that, I think, in a host of other niches, whether it's in things related to the grid, things related to critical minerals, things related to, sort of the ocean sector. So I'm excited, and I think it requires a different kind of capital than the check the box allocation approach. And that's both why it's hard, but that's also why it's interesting, because if you can find a early coalition of folks that want that, I think you can build, both diversifiers with alpha relative to just going all in on gold or Bitcoin.
One more last question about the report before we turn our attention to Summit. The report gives forth 3 examples of kind of areas S2G has leaned into this: structured finance, bespoke fund vehicles, and growth equity in the missing middle. Why are you pursuing all 3 and versus picking one and going deep? Why do all 3 matter?
I think when we observe a changing reality, we want to go after it with a thoughtful approach to time and attention, and hiring teams and hiring, experts, both on the investment side and on the operating side, and then empower them with ecosystem resources on corporates and policy and others to go after it. So that's the kind of firm we're building, which is a multi-product, firm. But we're trying to do it in a way that's more grounded in the emerging economic market reality, having it be proven, and then going it from subscale to less subscale and hopefully scale. So that's sort of the algorithm of financing reality. I think in PE growth equity, we see a lot of companies that have graduated from venture capital or never took a dime of outside money, but don't yet want to sell to a very mature and frankly crowded middle market private equity space. And so we're providing them capacity expansion capital, M&A capital, working capital to grow EBITDA, to scale revenue, and then when they're ready to exit to either middle market private equity or strategic in 3 to 7 years. And we didn't see a lot of that in the market. And so if you look at our current, growth portfolio, majority of it is EBITDA positive. It's companies that, needed, we were often the first institutional partner to really help with either value creation, ecosystem networks, policy help, bringing on operating partners that have had execution track record in that industry or similar industries on board. We obviously bring our playbook of investing on board to partner with those three things, and scale revenue and scale EBITDA and exit. And so that to me was is the missing middle that's what's missing in the missing middle is that. So that's one aspect. The second reality that we noted was these niche things in agriculture, and so then hence Clear Frontier, and they're off to the races, and we're excited about what they're doing. I think on structured finance, I think a lot of it has been either large infrastructure finance, which is infrastructure credits largely scaled and proven, but there's this gap between venture debt and infrastructure credit that's much more bespoke, that I think is an interesting opportunity to fund sort of distributed platforms that have that are finance, which is attached to cash flows. It's often delayed draw, and it's often bespoke structure. It's a combination sometimes of structured equity with mezz, or structured equity with mezz and senior, or mezz and senior, or it's a combination of a unit tranche approach, if you will. And I think that again is because there are companies that are not yet ready to absorb 200 million of infra credit. They don't look like infra credit, but they clearly are not getting banked by a regulated lender, or the traditional sort of either equipment finance, venture debt, all those things. They don't really fit that. And I think that that's an opportunity also. And really excited that we brought on Brian onto that team, and he's seen this movie before at Ares and at GIP. And so those are the three things where we've observed a reality. We've observed that the capital markets haven't, it's a round peg square hole, and we're like, well, we'll follow the reality because it's proven these things have EBITDA, they're scaling, but they lack a capital market and capital solution vehicle to finance the growth of it, and that's what we want to finance, is that growth.
So our Solutions Fund 1 closed at $1 billion on May 12th, just before Summit, and what many fund managers are calling the hardest fundraising environment of their careers. What got this done? I mean, just going back to these realities and the need for this closing the gap on the missing middle, I talk a little bit about the process and how this was recognized in the current state of things.
I mean, I was reflecting on this morning. I mean, it was probably the worst time to be doing it. We were in an air pocket. So, we launched summer 24, obviously closed early this year, or very recently. I think the air pocket we're in was like, we had sort of the euphoria of the IRA was over. And so we ran into an election uncertainty, then some macro uncertainties around Liberation Day, and just big, beautiful bill, and a bunch of things that had some macro and policy uncertainty. Two, I think the 21-22 vintage left a lot of people with bad taste in their mouth, particularly anytime you have a drawdown. I lived through 01, 02 as a junior professional, mid-level in 08, 09, and then obviously more senior in this drawdown, and each of them are the same. You have, a hangover that occurs, and then, questioning of power law, questioning of all these things. And so that occurred in our watch. And then there was a general view, let's go back to sort of, asset light, capital light software, things that are much more, proven to generate DPI and returns. And so it was, and then climate was out of favor as a result of many, what I just talked about. And I think, I think what got it done is deep sector expertise over 12 years, deep sector networks, our team. I think we had shown in our growth track record really positive data. I think the venture seed and venture, we had a playbook that started to work in terms of being more IR indifferent, and the power law coming from large ownership and getting companies EBITDA positive, and then exiting that. And I think, it was it was not one thing, but it was a combination of the 12 years of work, the focus on growth, the deep the team depth, both investors and operators, the ecosystem depth, and the most I think thing that helped is we had sort of a case study of these 9 or 10 companies that showed what this missing middle, particularly the EBITDA positive side that was with the first institutional capital in, and then we also more. I think we also obviously had an exit during that time period with that company, with one of the companies. So, it's never easy, these things. I'm actually like, if we went out now, I actually think it's a lot easier. You're through the policy uncertainties.
Yeah.
You have the tailwind of physical commodities are kind of back, particularly energy, but I think it's broader, including food security. And I think, I still think you have a plumbing system issue with the lack of DPI with even the most mature and proven managers. But, that's just causing some, I think that's a lingering issue still, but I think it'd be easier to go out now than when we went out, for sure.
Yeah, hopefully we're coming to the end of the air pocket.
Exactly.
Well, let's go back to Summit. I don't want to stray too far from learning about what we aim to achieve when we brought so many great folks together. We spent the first day unpacking your thesis on financing reality and really centered around the question of what can we learn from the market builders of this era and how can we inspire the market builders of the future? We put 6 people on stage who have each built something generally new in their own domain. Don Wilson in derivatives, Keith Crandall in biotech, Paul Lissack in finding the riches in the niches, as you say, Jason Warner in AI infrastructure, and then ending with a panel of Lucas Walton, Howard Buffett, and Jeff Davis on systems investing. What was the common thread that sort of ran through it all that really inspired you to bring this group together, and what did you learn from the day?
Yeah, I think the common thread is these people saw an emerging economic reality that was proven but subscale, that lacked standardization, that lacked a capital vehicle to scale it. So I think Don is one of the most successful traders and investors and frankly market builders that I've met, and he's done this not just in derivatives but in many things. He now has a notion that we're going to trade more compute than oil, and has built a compute platform to do that. Keith has, Arch was OG in sort of life sciences and recognized that, the capital formation for life sciences is long duration. It requires a different kind of capital solution. And, they among others were, I think, one of the architects of this phase 2, phase 3 capital market. They didn't obviously start it, but I think them and a cohort of others sort of validated it and reinvented it. And now we've got probably the most unique capital market for funding drug discovery in the world. I don't think there's any other country in the world that rivals the US in biotech drug discovery. And that's created enormous outperformance for certain folks, and enormous, economic. So they saw an emerging reality, which is life sciences, biotech emerge, but they saw a capital market system that wasn't going to fund a binary phase 2, phase 3, and then they kind of put and stitched it together again and again. And I think that, is important. I think Paul has done this in royalty finance and a lot of other bespoke areas where, as he calls it, no one else is fishing in the fishing hole, but there's fish there, i.e. economic reality there. But it's either subscale from an allocation perspective, or it doesn't have a financing vehicle. And clearly royalties are now very proven and mainstream, but he's taking these royalties that's proven in music and drug discovery and bringing it to other genres, and he's doing other things beyond royalties, obviously. I think Jason, as an operator and CTO GitHub and has his own LLM, has a notion of how AI is going to change financial services. And he was on the advisory board of Bridgewater and helping that at scale and to look at what AI does. And then Lucas built, in my opinion, at least 3 platforms that are, financing reality, and having had a front seat to those 3 with him and a co-founder with him on a few of them. He's lived this experience, and he does it he observes it reality from a systems lens. So not just one industry or one little thing. It's like, what's the second or third, or Howard
Right.
similarly. And Jeff has done this in microfinance, but now doing it in many other, genres as well. So including, real estate and other things. So I think it was great to have them be practitioners and show what they've done in observing an emerging reality, similar to how the joint stock company did with voyages to Asia, and sort of being pioneers and voyagers of it, and then build a market financial reality to match the economic reality and generate, outperformance.
Yeah. Of all those conversations, is there one that changed how you're thinking about a portfolio over the next few years the most?
I mean, I think all of them have like some influence about how thing, but Paul said something that I was super profound that I want to really dig into more. That I didn't expect him to say it on stage, and I think it was 30 years ago or 40 years ago. The majority of credit was to fund primary economic activity. So he said on stage, I think 85% of new credit was to fund, growth, CapEx, OpEx, like hit the real economy. In 15% was to do secondary transactions, so generate wealth effectively,
Right.
in my parlance. He said that number today is flipped. 85% of credit is formed to do secondary buyouts and provide liquidity, and 15% is to really finance growth. I'd like to dig into that more, but that to me was a profound way to be like, we've kind of, a lot of credit in private credit is sponsor finance. A lot of the sponsor finance is to allow for liquidity of, secondary liquidity for shareholders, either private equity, other private equity funds, or owners. And so we have a lot less credit than we did 4 years ago. It may not be 85-15. I'd be curious to dig into that. But that is a real sort of interesting economic trend. And it goes to what Nixon did and fiat currency and sort of the delusion of money. It goes to this wealth effect that's occurred where, there's a reason that top 10% Americans now represent, I think, 55% of consumption. And so to me, that had a profound impact, because I think what we've always tried to do is like, how do we get as much money into the real economy, create jobs, create sort of fixed assets or intangible assets that move an industry, move a sector and forward. And that statement I still think about.
Looking forward, just would love to pivot this to what our audience can take away from the insights in the report, the conversations at Summit, and just your perspectives on the age of adaptation. So if I'm a large pension fund and I've spent the last decade investing in software and growth equity, what is a small defensible first move I can make to start positioning for the environment and opportunity you describe in this report?
It's the report, but it's also the day two
age of adaptation.
work, is the correlations you're used to, the approach on passive investing that the market is obviously largely benchmarked around, i.e. modern portfolio theory. The first thing I'll do is like, does that survive what's happening today with these five forces? And two, a lot of the returns that were made were based on leverage. When you go from 3 trillion to over 300 trillion of debt, that is a driver of performance. So the first thing is like, is the past the future? And then if you want to future proof it, the one easy one is diversifiers. It doesn't need to be farmland. It doesn't need to be, but I would encourage the role of diversifiers. And I think that's important. In terms of how you play private assets, I'm obviously, biased on what, but I think the role of the physical economy as a constraint to the compute token economy I think is something and I think all the obvious ones are kind of played out.
Mm-hmm.
And so I would go to what's the next onion peel. Because there's 2 or 3 levels of onion peel that I think allow you to get exposure to that. That's interesting. And then the other thing I think largely people are focused on mature, managers. And so to doing a fund one these days is very difficult. And I would say if you're going to do a fund one or an early vehicle, just is it matched to the emerging reality of it, or is it more a better way to do beta?
Yeah.
I wouldn't bet on the smartest analyst in beta. I would more bet on, someone that understands emerging reality and that has a proven but fit for purpose capital market instrument that they're trying to build.
Yeah, that's great. And which kind of leads me to my next question, which is you talk about reality is found, not built. Financeability is built, not found. For someone who wants to be a market builder of this era, what's the first thing they need to do? What's the first piece of work to dig into?
One, really be an expert in that emerging reality, like every aspect of it. And so that would be the first. And that could obviously take years. 2 is then really understand how do you get close enough to the current financing reality, but tweak it enough also to match that emerging reality. And I think you need a capital solutions mindset to really do that well, and not a check the box mindset.
Yeah.
And so it takes a bit of nonlinearity, a little bit of creative thinking to do that.
That's great. One last question. You called this the most interesting moment in our sectors you've witnessed in over 2 decades. What's making you most excited and energized about this moment?
I think one is, the secular demand flows based on these 5 forces, whether it's load growth, et cetera, is enormous. 2, I think these 5 things are causing the assumptions of the supply chains of the last 30 years to be really in question. Urea prices since the race roots have gone up dramatically, and in some cases they're not available in certain geographies. And so I think things like food security and sort of ocean and maritime sort of flexibility and mobility are being challenged as we speak. And so, you have the 5 forces of age adaptation causing secular demand, and you have the current system providing real price signals on volatility. And then the third thing, though, you have to match that with is both the companies, the products, the services that match those 2 realities. And I think that's what's, to be honest, exciting. It takes it's labor intensive, to be clear, and intellectually intensive, because you need to be a combination of subject matter expert and systems thinker. But I think that's the kind of firm we're trying to build.
This has been so fascinating. Really appreciate your time, Sanjeev. Congratulations on the close and the launch of the report and all the great conversations coming out of Summit. So thanks for being here.
Well, thanks for everything you're doing, Tonya. I think we couldn't have done it without you.
All right. Thank you for tuning in to the S2G podcast. If you enjoyed this episode, please subscribe, leave us a review, or share it with a friend. For more information or to connect with us, check out s2ginvestments.com.